Short-term pain, long-term gain. Today marks the beginning of a new era for the home equity conversion mortgage, the financial assessment. I'm Shannon Hicks and welcome to the Industry Leader Update. As you watch today's episode, you are now faced with a whole new set of guidelines in qualifying prospective reverse mortgage borrowers. The assessment is one of the last ripple effects resulting from the housing crash. HECM defaults began to swell in 2010, hitting FHA's Mutual Mortgage Insurance Fund and also raising concern about the program's long-term financial viability. First, a little perspective. One factor contributing to HECM defaults before credit history or financial capacity was measured was the structure of the loans themselves. In other words, the fixed-rate, full distribution HECM loan. Many borrowers faced with plummeting home values who had already spent the proceeds from the loan were reluctant later to pay their property taxes and homeowners insurance. And even worse, there were no funds left to cure the default. Some homeowners may have thought, why sink any money into my home when its value has dropped significantly, ignoring the risk of default and possible foreclosure. Now, prior to the assessment, HUD made several changes to the HECM program, which substantially reduced the risk of future defaults. And those included principal limit reductions, elimination of the standard fixed-rate HECM, first-year distribution limits, and the allowance for younger non-borrowing spouses on the loan. These measures themselves should dramatically reduce future claims against the insurance fund, especially now when coupled with the assessment. In the short term, those improvements have yet to be seen today. The silver lining is that HUD has the authority to make changes quickly in the future outside of the lengthy, long, or rulemaking process. Now, what this means is that nothing is written in stone when it comes to originating reverse mortgages. While the assessment is the latest effort to reduce risk to FHA and lenders alike, we should see changes in the future. The good news is that the assessment is already comprehensive in nature. If we see the actuarial analysis of FHA's portion of the insurance fund improve markedly, the assessment guidelines could be modified, making them less restrictive. Today, the HECM is more similar to its counterpart, the traditional or forward mortgage, with income, expense verification, and full financial underwriting. With this in mind, I can personally recall several past reverse mortgage clients who wanted the loan regardless of future risk. And many of us suspected the ultimate risk of future default, but were powerless to act. Loan officers and lenders were placed into the uncomfortable position of being unable to deny these needs-based borrowers without discriminating. Well, the assessment now places a uniform standard across all borrowers, and the process curtails the using of the loan as a short-term fix. It'll also stop some from using the HECM as a Band-Aid loan. Now, what are your thoughts? Do you think that HUD will eventually loosen assessment standards in the future if the program's financial health improves? Leave your comments in the comment section below and have a great week.